Hi, I'm Jeff Bermet. I'm the CIO of Oak Glen Wealth, and I'm one of the portfolio managers on the Libero Dynamic and Solution Funds. And I'm going to run you through what we did in June and a bit of our investment outlook for the rest of the year. June was the first month for us here at Oak Glen running the Libero Dynamic and Solutions portfolios. On balance, the Dynamic portfolio, the sterling share class, was up 1.66%, and the Solutions portfolio, again, the sterling share class, was up 0.71% for the month. And obviously, the euro and the dollar share classes, there might be slight differences in performance. So June, as I said, was an interesting month because we saw the US equity markets continue to climb, particularly in the tech space as the big tech names went ever higher. We saw European stocks negative for the month. In terms of bigger themes in the background that influenced the markets for the first 6 months of the year and will certainly influence them for the balance of the year, one has been central banks fighting inflation. And finally, we've seen enough of a reduction in inflation that the ECB chose to lower rates at the beginning of June. And the Fed and the Bank of England, while they did not cut rates in June, have been continually hinting that they are getting closer and closer to the point at which they could do that. So this is a big change. And then I think the second driver for this year has been the AI revolution, tech. Those firms seem to be participating in that business or benefiting from it. So whether it's NVIDIA designing the graphical processing units, or TSMC making those units, or even Microsoft and Meta and Amazon who are buying those GPUs and building huge large language models to run AI software in their products, all those firms have done incredibly well this year. And it may have sort of dragged the whole equity market with it.
So in terms of AI and technology, which are the hottest topics at present, and again, everyone, including the big technology companies, believe this to be the case and are investing heavily in these areas. NVIDIA is the stock that everyone's talking about. And we've looked at this and looked at the valuation, and we find it too rich to take on. So therefore, we've looked around the sector, looked for investments we think that will benefit from this, or perhaps the other horses in the race. To that extent, we've looked at things like Qualcomm, another one of the big chip makers, and also we have holdings in Samsung and TSMC within the portfolios, two of the other big chip makers in the world.
So I mentioned that we spent all of June rearranging or changing the portfolios to reflect what we like. So the sectors that we like, and this isn't in order of priority, but just defense. The war in Ukraine, so physically close to Europe, it has prompted European governments to decide to spend more money on defense, and that benefits defense contractors that produce that equipment. The second area we like is energy, particularly oil and gas, because again, we believe that there just has not been enough spending to increase capacity to get more oil and gas out of the ground. But there's now a third driver that's coming into the marketplace, which is much harder to make sense of what it's going to do, and that's these elections that are happening. So despite these elections and the concerns about them, it still remains an incredibly benign investment environment for risk assets. And we're getting a new government in the UK. We may get one in France. Well, we're certainly getting some version of a new government in France, and we may get a new president in the US. How these countries attempt to deal with these fiscal issues is going to be critical. Because of President Biden's terrible performance in the debate against Donald Trump, the markets are leaning more towards a Trump victory. And one of Trump's pledges for his new administration is to renew the tax cuts that are scheduled to expire in 2025, so to make the deficit larger. And the bond markets are like, not sure if we like this, and bond yields in the US have been drifting higher in the longer maturities. Okay, that's our review of June and our outline of our outlook for the balance of the year. We look forward to meeting with you regularly and presenting monthly updates and any changes to our outlook that are significant.